The last time Amazon had a decline like this, it dropped 80% in 2000, and the people that bought did pretty well, I would say, off of that trough. Now, the question is it done dropping? It's down about 50% on the year.
That is the question. That's the question everyone's asking themselves as of now. Is Amazon finally done dropping? We have articles now from CNBC pointing out that Amazon has come full circle, all the way back to the COVID lows. During the pandemic, Amazon dropped all the way down to $84 per share, and that was considered a steal. Well, here we are. We find Amazon currently trading at $85.14, and it's dipped below that $84 mark. So now we have Amazon right back to where it was in 2020. It's made the loop like so many other companies, but Amazon's a pretty unique company. Amazon is a well-established juggernaut of a company that does $500 billion in revenue, $500 billion in revenue in 1 year. And this company's trading at the lowest point it has in years. So we know that Amazon is this vast, complex company that can be very difficult to understand because it has a lot of moving parts. And what I want to do is boil down this company into something that's easier to understand. We're going to be looking over the good of Amazon and the bad of Amazon and my predictions of where this company's headed in 2023. So I hope you'll get a better idea of where Amazon currently is standing and what it's facing in 2023. Now, before we jump into Amazon specifically, I have to do a quick portfolio update. This is real money. The Story Fund is a tech portfolio that I started in 2021. Like most tech portfolios, it hasn't done well this year. So when I look at the holdings page here, this gives some clarity into the situation. Basically, what I have here are companies, and I've weighted them a certain way, where I've put more money into the companies that I have a higher long-term conviction of these businesses. So my top holdings right now, the ones that I have the highest level of confidence and conviction, are first Amazon, the company in question today, and then Netflix. That one's a little bit more of a contrarian pick, but I have a very long-term thesis on Netflix that I see playing out really well in the future. But we have Amazon here with the majority of the money invested, and this one is where I have lost, or rather have unrealized losses right now, the most. I'm $21,700 in the red. Now, most of my losses in this portfolio, which I'm currently down 31%, most of this is unrealized. In fact, almost all of it is, which means the companies have come down in value, but I have not been selling out of them. I've just kind of held on to them, and if my thesis plays out over the long term and these businesses do well, I think the price will recover. So you can consider this lost money as of now, but really it's unrealized losses. Amazon is down 21,000, Netflix is down 12,000, even Google is down 4,000. So it seems that really no company is being spared right now. Even Apple is getting close to getting in the red. So there you have it. There's a portfolio. If we look at it compared to the S&P 500, this is what it looks like here. The S&P 500 is in red. The Story Fund is in blue. So you can see I'm trailing it about the same by around 20%. So I'm lagging behind the S&P 500. The goal is over the next 5 years to hold on to these companies. Hopefully they'll do really well and I can have the portfolio recover and surpass the S&P 500 because I'm using this as the benchmark. SPY is incredibly difficult to beat. It's something that a lot of fund managers and individual investors struggle to beat. So that's the challenge. It's a very high bar to try to beat the S&P 500. Right now we're a little bit behind, but I do think we still have a chance. I really do. We're down 31%. And I'm still optimistic. I think we have a lot of time to be able to catch back up. So let's go ahead and take a look at some of the news here and why people are discussing Amazon again. And all of a sudden, this company's in focus from investors. This headline from CNBC paints a very clear picture of what's going on with Amazon. The stock has given up the last of its pandemic gains after almost a 50% slump in 2022. And that almost 50% slump, it's 50%. We're there. So this is the full circle. We went up, around, and right back to where we started. We've seen this with so many tech companies. They're right back to their pandemic lows. So that's the basic reason why a lot of investors are once again considering Amazon stock. It hit this nice little landmark of the 2020 lows, and that brings it in the news again. But what I think investors need to consider is there's a lot of concerns that I have about Amazon going into 2023 that I think some investors might blindly just buy the dip in Amazon and they won't have the conviction to hold for another year because I think this next year could be challenging. And what I did was I spent some time and I wrote out what I think are the bad parts of Amazon right now. Simply put, the parts that drive investors away and why I think this stock could continue to trade down lower. We had the CNBC guy earlier say, will the stock go lower? I think yes. I think there's a very good chance of that. And these are the reasons why. Let's just start off with number one here, high PE ratio. Let's take a look at Amazon. We're using Qualtrim Insights. This is a website that I developed over the past couple of years, and we're doing a lot of improvements to it. You can try it out as part of the Patreon membership. But what we see here is that Amazon trades at a high PE ratio. Its trailing PE is 80. That's very high. And then the forward PE is 44. A 44 forward PE. That makes basically every other company look cheap. It even makes companies like Tesla look inexpensive. It makes Meta and Google look dirt cheap. From a PE ratio, Amazon looks expensive. And right now we're in a market that does not like expensive stocks. I don't know if you've gotten the memo, but if you've been paying attention to investing at all, any company that has anywhere near a 30 or 40 PE has not done well over the past year. Just any of them. Name any company with a high PE, it likely hasn't done well. Number two, Amazon's free cash flow has been negative for 2 years straight now. So you might be thinking, all right, we look at companies and we can look at the price to earnings ratio, but that's not always the best indicator of how much cash they're actually generating because the earnings can be gamed a little bit. But the cash flows, the free cash flows are what you can look at. Well, Amazon's free cash flow yield currently, based off the past year, is minus 3%. That doesn't look good. When we look at the free cash flow chart here, this is the free cash flow of Amazon since the very beginning of this company, going all the way back to 97. It's almost always been free cash flow positive, except for the past 2 years. Starting off in 2021, if we cross to this territory, Amazon's free cash flow is negative. Both years so far, negative. There's only one quarter where they actually posted positive free cash flow out of the past 8 quarters. This is amazing. Investors are not only looking at a company that has a high PE ratio, now they're looking at a company that has no free cash flow. Number three, Amazon has slowing revenue growth. This is going to be one of the key things that investors are looking at in 2023, one of the big concerns. For a company that trades at a high PE ratio, implied in those earnings is fast growth. That's what investors want. They're willing to pay more for a company as long as there's an assumed level of growth that makes sense, as long as a company is going to grow into that multiple. With a 44 PE ratio and negative free cash flow, there's a lot of growth implied in the stock Amazon. And what we're looking at right now is a company that has growth in question. Growth may be slowing over the next year. We look at the revenue growth year over year, and last year it was 14.7%. If you factor in currency, it's a little bit better, but that's been a headwind for them. But overall, 14.7%, not terrible, in my opinion. I don't think that's too bad, but it's not anything like how they've been growing over the past decade. In the past decade, Amazon has averaged a 25% revenue compound annual growth rate. 25%, and it's been decelerating down to 14 and 15%. So growth is starting to slow down, and in 2023, growth is going to be a major question mark. I think that if growth slows down at all, lower than analyst expectations, that could be very bad for this stock. So far we have a company with a high PE ratio, 2 years of negative free cash flow, potentially slowing revenue growth, which is something investors are going to be paying attention to a lot, and then growing stock-based compensation. This is another thing that's a growing problem for Amazon. The expenses of the company. When we're looking at a company's free cash flow, it makes sense to factor in the amount of stock-based compensation the company's paying because that's a real expense. To pay that, they have to dilute the current shareholder base. So when I toggle this toggle right here in the middle, it brings up this new bar, which is a little purple bluish bar here that shows us the amount of stock-based compensation that Amazon is doing quarter over quarter. If I zoom in on this, we can make it a little bit clearer. If you can see the trend here, the amount of stock-based compensation is going up dramatically. A really rapid pace. And that's while the free cash flows are going down. So we have expenses going up, we have cash flows going down at the same time. Obviously, this is not what investors want to see. This is a number of things unique to Amazon. These aren't problems that every company has. I can name a lot of companies that have positive free cash flows and they don't pay much in stock-based compensation. But Amazon is facing all of these issues at once. And on top of that, Amazon is a tech company, always thrown in the tech basket with the QQQ. And what are tech companies facing right now? They're facing a high interest rate environment. This is another thing that's a real concern for Amazon. If we look at the federal funds rate here, this illustrates this, I think, the clearest. We have in 2016, federal funds rate going up, interest rates climbing a little bit as the economy was doing okay then. And then we get up to around 2.4% over like a 3-year period. So it took 3 years to get interest rates up 2.5%. And what has the Fed been doing? Look how steep this climb is. 1 year, we have interest rates going from 0 up to 3.78%. And the Fed just said in their most recent meeting that they're not done. Interest rates are going to keep going up. So we have that major macro headwind as well of higher interest rates and potentially teetering into a recession next year, which of course Amazon is a company that sells a lot of stuff to consumers. A recession would not be good for Amazon. But overall, this is a list of the bad. Things that you should know about if you're deciding to purchase this company. If you're just going to buy the dip, you shouldn't be surprised if the stock continues to go down in price. There's a lot of things that Amazon's currently facing that I think it's going to continue to face for the next year. Now that we've highlighted all the bad parts of Amazon, it paints a pretty grim picture of the company. But there are some good things, and good things that I think are worth highlighting. I actually went through and made a list of the things that keep me invested in this company, the reason why I continue to hold it, and will probably be continuing to add to my position. Let's go through these one by one. First of all, inflation is a problem. It's driven down equity prices to a substantial extent. Every investor needs to acknowledge the role that the Fed plays. It's had a big impact on Amazon, as well as every other company in the market, but especially companies like Amazon. The good news with inflation is that it does seem to have flattened. I really think inflation is starting to at least peak and flatten, and if anything, it's headed on a downward trajectory. We've had month after month after month of inflation coming down steadily, quicker than expectations. That's great news. That's a great tailwind for these type of companies over the next year. And not only that, but we looked at the chart here of the federal funds rate spiking upwards at this insane rate. That's true, but again, this is in the past, and the federal funds rate is likely going to be leveling out at around 4.75, 5.25. That's the range that the Fed thinks that they'll have to go. And if anything, I'm in the camp where I don't think they're going to have to go that high. I believe Jeremy Siegel is more accurate with his predictions, and I certainly don't think the federal funds rate will keep skyrocketing like it has over the past year. So I view this as a positive thing for Amazon over the next year. I think that the inflation story will largely be playing out in a positive way. Inflation will go down, the federal funds rate will level out, and that gives us a bit of an anchoring point and something more stable to look at than just wondering how high these numbers will go. Now, number two, Amazon has grown substantially since 2020. Remember, Amazon right now is trading at the same share price it was in Q1, Q2 of 2020. But the business has grown in every way possible. Let's go ahead and just look at the top line growth of the company. We can switch to annually here. This is what it looks like. The revenue of the company in 2020 was $386 billion. So the revenue's gone from 386 to this year, it's going to be above 500 billion, half a trillion. You break that down and it's a 70, 80% increase in revenue. But more importantly, Amazon is growing quicker in the right places. The company's growing faster in the most profitable portions of the company, and it's growing slower in the most low margin parts of the company. The parts that have grown particularly fast over the past year are Amazon's web services, ads, and third-party sales. All the service portion of the business that has the highest margin. We can break this down on their earnings report. Let's go ahead and look at Q3 of 2020. This is when Amazon first broke out their ad business. Before this, they didn't reveal the numbers, but they finally gave us our advertising services here and the actual numbers. It was $4.9 billion in Q3 of 2020. Now we look at the same business line, but we zoom to current day. This is the advertising services, and we have Q3 here, $9.5 billion. So the advertising revenue, this business has grown by 90% since Q3 of 2020. 90% bigger, but the stock is trading at the same price. We can also look at third-party sales. Again, this is the more lucrative, more high-margin part of Amazon's retail business, and it was doing $20.4 billion in revenue in Q3 of 2020. We compare that to current day, and we have right here, Q3 of 2022, $28.6 billion. That is a 40% increase in the amount of third-party sales. And then we can look at another piece of data here and see how fast their other profitable business has grown, which of course is Amazon Web Services. This chart shows two different things. The red line is the actual AWS revenue. So this is the one that everybody looks at. The red line is the revenue. And the revenue is actually growing incredibly fast. I know it doesn't look like it on this chart, but if we just looked at it on its own, without the other data there, this is what it looks like. fast revenue growth. And this is quarter by quarter growth. But when we add in commitments, that is the amount of contracts that are 1+ years of AWS. That's actually growing at a faster rate than the revenue. AWS's revenue in Q3 of 2020 was 11.6 billion. Q3 of 2022, it was 20.5. So it's grown nearly 90% since then. Again, this is at a point where the stock is trading at the same price, but the company and their biggest components of the company are growing 40, 90, and 90%. Then we look at the amount of commitments to make sure that we have customers lined up in the future. These are contracts that are beyond 12 months. In Q3 of 2020, Amazon had $44.8 billion in AWS commitments. In Q3 of 2022, they have $104 billion. So that's gone up over 100%. And on an interesting related note, Amazon is actually growing their cloud business commitments while Google is struggling to. You can look at them in contrast here. Since Q4 of last year, Google's commitments to their cloud business have basically flatlined. They haven't really grown at all, and Amazon's have continued to grow at a steady clip, growing from 80 billion now to 104 billion. So that's just an interesting thing to see. This shows that the companies that have the head start, that all the developers already know how to work on, oftentimes they're the default choice. So far we have two good things for Amazon. Inflation does seem like it's already peaked. It's on the way down. The federal funds rate might go up a little bit, but they're going to come down as well. And then we have Amazon. The story of the slowing growth, I don't think paints a clear picture. Most investors will focus on the top line revenue growth, like all revenue is equal. But if you look a little bit in what's actually going on, the revenue that's growing the fastest, AWS, the ads business, and third-party sales, is the most important revenue. The overall revenue of Amazon may slow down, but that's from the first-party sales. That's very low margin revenue. So in my opinion, this point 2 is very important. I think the parts of Amazon that are growing the fastest are the most important parts. Now, the third point here is that Amazon is addressing these rising stock-based compensation expense and employee expense. Amazon has had a ton of hires over the past year. They doubled the size of their workforce. They hired like 600,000 people. They expanded their network double. I mean, it's crazy what they've been doing. And that's what's really caused this stock-based compensation to just take off over the past year. But this is something that Andy Jassy is addressing currently, and he's going to be addressing in 2023. We have reports that the layoffs are being extended, that Amazon is looking at cost cutting, budget cuts, everything they're doing. They have an expected ROI. They have a very strict investment policy. I think this is a lot more strict than investors are giving it credit for. I think that Jassy is going to be a lot more strict with cost cutting and cost control next year than what investors are expecting. So when I look at Amazon and their stock-based compensation and their growing expenses, I don't see that continuing to happen over the next year. In fact, I would not be surprised if we saw this purple line here, the stock-based comp, start to level out and then even go down next year. I think that will likely happen. And then in addition to direct cost-cutting measures of laying off employees, Amazon is also doing warehouse automation. This is something that is happening. This is point number 4. I've shown the videos of this before. It's actually incredible to see. Amazon came out with this new robot called the Amazon Sparrow. And a lot of people look at this and they think it's cool, but I've seen robots in factories before. And unless you're an engineer and you're specifically a robotics engineer, you probably don't have much of an appreciation for this type of thing. At least you probably don't know how good it is or how bad it is or how technologically advanced it is. From what I've read from different people that specialize in robotics, this thing is like a breakthrough. It does picking. It does sorting. It does the one thing that robots could not do to this extent. This thing can sort millions and millions of different items, all unique, different sizes and shapes, into different baskets. And this is one job role at Amazon that's extremely common. But Sparrow, this robot here, also addresses a bigger issue, which is Amazon has too many employees. They simply employ too many people at their warehouses with too high of turnover. So it's too expensive to keep running the company this way. So we need to see a lot of automation like this and at least the worst jobs at the warehouse. And picking is a big one, but Amazon also has a number of different robots helping to automate their warehouses. As this continues, I think that margins will go higher. Now, the last thing that I'd highlight, and this isn't really specific to 2023, but it's something that I think is worth mentioning with Amazon, is the high customer lifetime value. Part of the reason that I feel okay as an investor holding a company like Amazon through this massive volatility, through 50% drawdowns, and I still feel at ease, is because of the lifetime value of a customer of Amazon. I look at the services this company offers. Amazon Prime, with the 2-day shipping, with the music, with the Amazon Prime Video, with the sports, so on and so forth. I think the amount of customers that are going to cancel that service over the next 10 years are minimal. I think the amount of customers are going to grow over time. And I think the lifetime value of a single customer is dramatic. I've been a member of Amazon Prime for over 10 years, and I can't even imagine canceling it. It is just a part of my life. It's one of the most basic services that I'll probably have for the next 2 decades. Then you have AWS. When you're building different websites and you build them on AWS, you're basically locked in. You could try to move off of it, but it's a huge endeavor and you'd have to have significant incentive to move off of it. So Amazon has high lifetime value in their Amazon Prime membership. They have high lifetime value in their AWS service. And with the Amazon Prime business, that's also directly linked to their advertising business. So when I look at the different services that Amazon offers, I think that they have a higher lifetime value than most other companies. Amazon's going to be around for a long period of time. They don't need to figure this out in 6 months or in 1 year. They have a lot of time to be able to figure this out because they have customers really locked into their services. I think customers are locked into Amazon services far more than other companies I do analysis on. Lots of companies come and go. In my opinion, Amazon is pretty entrenched. I think it's going to be around for a long period of time. It has a long runway to be able to figure out how to best monetize their customers. So that's it. That's both the good and the bad of Amazon. In my opinion, going into 2023, I wouldn't buy the dip today expecting some huge rally. I think there's too many negative catalysts and things that Amazon needs to figure out. But long term, next couple of years, 3, 5, 6 years, I'm very bullish on the company. I think there's so many things going for it that investors aren't paying attention to because of short-term noise. That's all for now. I hope you enjoyed. See you in the next one.